it's like I said in my Rules Research article, what COMEX is saying is the case for gold is now almost too obvious for anyone who takes a half an hour to understand what the COMEX really does and what these flows really.
You're watching Silver News Daily. Subscribe for more.
Gold is standing at the edge of the most explosive surge in modern financial history, and almost no one is ready for what's coming. For decades, Wall Street and the central banks have worked tirelessly to suppress its true value, rigging the markets, manipulating prices, and using paper gold contracts to maintain their illusion of control. But that illusion is beginning to crack. The COMEX manipulation scheme that has kept gold's price artificially low is now on the verge of total collapse. And when it finally breaks, the price of gold won't just rise. It will skyrocket in a way that will leave the world in shock. Think about it. Every major currency crisis in history has led to one outcome: a flight to gold. And right now, we are witnessing the greatest monetary breakdown of our lifetime. The US dollar is in free fall, central banks are scrambling to secure real assets, and confidence in fiat money is crumbling faster than ever before. But there's one detail the mainstream media refuses to talk about. The game being played on the COMEX is reaching its end, and when the dust settles, gold will emerge as the ultimate winner. So, what happens when decades of artificial price suppression finally snap? How high could gold actually go? And why are financial elites preparing for a world where fiat currency may no longer hold any real value? Stay with me.
Yeah, obviously it's a lot. All of us in the industry certainly track this, and I think you and most of your viewers kind of get a sense of what's going on. As usual, we can rely on the mainstream financial media to give us very eloquent but misleading reports. To your point, massive outflows from the London exchange to the New York COMEX exchange, which is the futures market. We're looking at 400 metric tons since just pre-Trump entering the White House just in the last few months, over 75% increase in physical gold at these COMEX warehouses. And again, for anyone who kind of accepts what we've known for years, and I've written about for years without a tinfoil hat, that we know that there's a permanent boot to the neck of the gold price every morning at 8:30 a.m. out of the New York Exchange. A number of too big to fail banks and bullion banks, about 8:30 every morning, they have a large paper futures contract short to dwarf the physical gold price. It's not a conspiracy theory. We know that happens. And we know that under certain regs, they can lever a certain amount of physical gold against a certain amount of paper. Typically, it's 4% physical gold and 96% paper contracts to keep a permanent short, really, to legally price fix gold and silver. And what we've seen in the last few months, which is no surprise, is the COMEX is thirsty for more physical gold for a number of reasons. The headlines say that the COMEX is worried about tariffs under the new administration on gold imports. So we got to get gold in now before those tariffs kick in. The other very eloquent and reasonable argument is there's a price arbitrage between the spot catch price in London and the futures market in New York. And so you got to move this physical gold to do an arbitrage play. Again, to the average person reading the New York Times or the Wall Street Journal who doesn't track COMEX or futures markets, that sounds perfectly reasonable. The obvious reason to any of us who understand, whether it's Peter Umbro who brought this out or the WikiLeaks years ago, since 1974, the reason the COMEX was created was to legally price fix the gold price. And the way to do that is to have a certain amount of physical gold on tap so that you could meet Basel III regulations and commit to this legalized futures contract price fixing. What's happened now is the COMEX is running out of physical gold. And why? Because typically on the COMEX, for years and years and years over a generation, these futures contracts are just rolled over in a perpetual game of we'll pretend to order, you'll pretend to buy, we'll pretend to take delivery. But really what happens is we just extend the contracts. All the futures contracts for very cheap are just renewed for almost no cost because that just keeps the liquidity, quote unquote, the trade moving. But what's happened now is you're seeing a 750% increase in open interest on the futures market. That's fancy lad talk for counterparties on the COMEX actually want their physical gold. Okay, they want their physical gold out of the warehouses, and the COMEX in New York simply didn't have enough. And so what does that mean? Well, it means a number of things. First of all, it means, as Andy...
For decades, the COMEX has been the battleground where gold's price has been systematically manipulated, keeping it suppressed through an intricate web of paper contracts and derivatives. It's a game that benefits the banks and financial elites, while keeping the true value of gold hidden from the world. But now, the cracks in this system are widening, and the entire house of cards is about to come crashing down. Here's how the scam works. The COMEX operates on a futures contract system, where traders can buy and sell gold without ever touching a single ounce of the physical metal. For every 1 ounce of real gold in COMEX warehouses, there are dozens, sometimes hundreds, of paper claims representing that same ounce. This system allows the big banks to flood the market with artificial supply, suppressing prices and maintaining the illusion that gold is just another commodity, rather than the ultimate store of value it has been for thousands of years. But here's the problem. When confidence in fiat money starts to evaporate, investors don't want paper gold. They want the real thing. And right now we are seeing an unprecedented shift as traders are demanding physical delivery rather than rolling over their contracts. This is putting unbearable strain on COMEX's already thin gold reserves. And the moment they can't meet those delivery demands, the entire manipulation scheme falls apart. We've already seen glimpses of this unraveling. In recent years, COMEX has been forced to import massive amounts of gold just to cover delivery requests. And now, with central banks and major investors racing to accumulate physical gold, the availability of real metal is drying up fast. The moment the COMEX can no longer hide behind its paper scheme, gold's price suppression will shatter, and we could see a price revaluation unlike anything in history. But COMEX's troubles don't end there. This system isn't just fragile. It's been at the center of some of the biggest financial scandals in history. And no institution has played a bigger role in this rigged game than JP Morgan. Their price manipulation schemes have finally caught up with them, and the fallout could send shockwaves through the entire gold market.
The COMEX was so many things. It is clearly putting a threat to the manipulation. That game that's been going on since 1974 just saw a twist. They just lost their best pitcher, so to speak. Their third baseman, their shortstop, and their best pitcher just got injured. That game is now changed. The question is, as they've taken 400 metric tons and counting in the last few months, the last few weeks, will they have that available to continue a new lefty or a new curveball and continue this game? Or will the gold go right back out for delivery? That'll be interesting to see. But regardless if they can continue this, that certainly is one of the reasons the gold price continues to rise. Because the manipulation ability, the curveball, the fastball, the heater is less than it was a month ago. But in addition to that, the ongoing continued purchasing by central banks is still going. So the combination of Eastern central bank purchases and the COMEX price fix in New York simultaneously pro-gold is undeniable. And the question now is, it's just, as I've said many times, this is just the first inning in the gold price. This is just the first inning, not peak gold. And the sad reality is we can talk about all the other things that Trump is doing and all the positive new wind and new energy. The debt crisis, the same things we've been talking about for years are coming to roost now. And again, what happens when the 10-year yield goes past 5, 6, 7%? What happens when mortgages go past 9%? Who will purchase the next 10 trillion in U.S. treasuries that need to be rolled over in the next year? We can argue about McKinley or Hoover and the tariffs and whether that'll be good or bad for the U.S. or inflation. And we can argue about one executive order after the next at Doge or the USAID or whether executive order after the next will help. But we're missing the lighthouse through the fog. All this fog, all this energy is important. But the lighthouse, be very clear, the lighthouse is we have too much debt. Our U.S. Treasury is no longer considered the most favored strategic savings reserve asset by the rest of the world. That is the reality because our debt has gone from 36% of GDP to 125% of GDP, from 246 billion in 1971 to nearly 37 trillion today. That is the simple lighthouse. Again, all of these stuff we can talk about, tariffs, trade, Doge, USAID, cutting spending, Musk, Trump, all of it's important. But the real problem is it's all fog. No matter how well-intended, bad-intended, whether you love it or hate it, no one, including Santa Claus or Papa Smurf, can get around the fact that our debt is too big. No one trusts our sovereign debt anymore. They prefer physical gold. That's not a gold bug argument. That's history in motion. And it's really important that what we're seeing on the COMEX, what we're seeing at the Treasury auctions, and what we're seeing at a doubling of U.S. gold purchases by central banks since we weaponized the world reserve currency. This is not a coincidence. This is not a gold bug case. This is history happening right now.
J.P. Morgan. The name alone carries weight in the financial world, but behind the polished image lies one of the most blatant and long-running gold manipulation scandals in history. For years, this banking giant has been at the heart of a price-rigging operation so extensive that even the U.S. Department of Justice had no choice but to step in. In 2020, J.P. Morgan was slapped with a staggering $920 million fine for manipulating the precious metals market through a fraudulent trading tactic known as spoofing. But here's the real problem. That fine was nothing more than a slap on the wrist. The manipulation didn't stop, it just went deeper underground. So what exactly was JP Morgan doing? It's simple. Their traders would flood the market with fake buy or sell orders they never intended to fulfill. This created the illusion of supply and demand, tricking other traders into moving the price in a direction favorable to the bank. Once the market reacted, JP Morgan would cancel the fake orders and execute real trades at manipulated prices, raking in billions at the expense of everyday investors. But here's the real kicker. This wasn't just the work of a few rogue traders. JP Morgan's manipulation went all the way to the top, with senior executives overseeing and profiting from these schemes for years. And if you think they were the only ones playing this game, think again. Other major bullion banks have been exposed for similar tactics, and despite the fines, the system remains rigged. However, manipulation like this can only last so long. The reason these banks have been able to keep gold's price artificially suppressed is because the market still believes in their ability to deliver real metal when needed. But what happens when that illusion shatters? Right now, we are witnessing a major shift as more investors demand physical delivery of their gold instead of settling in cash. This is draining COMEX vaults, and JP Morgan, once the master manipulator, is now caught in a game where they may no longer be able to control the outcome. The moment they run out of real gold to back their schemes, the entire system could implode, sending gold prices skyrocketing overnight. And this isn't just speculation. We're already seeing the early warning signs in London, where a major crisis in the physical gold market is unfolding. The world's largest gold trading hub is facing an unprecedented liquidity crunch, and when London runs out of gold, the rest of the world won't be far behind.
To be determined, but gold's reaching all-time highs. My view is, and what we have to be careful and what we need to watch is what we're really seeing, fascinatingly, is the world wants physical delivery. The COMEX didn't have enough. It's going right back out. And what that means, again, not the end of the world, not the end of the dollar, not gold going to 20,000 tomorrow, but we're getting fairer and fairer price discovery. The COMEX is running out of its traditional tricks. It's trying to reload its gold. How long it can hold it there is to be determined. But regardless of predicting that, what we do know is what we've been arguing for years and for months and now for weeks and days. This was going to break. I've been writing about the COMEX for 3 years. I said, just keep waiting until they need more physical gold because they run out because there's more demand for delivery, more open interest, which is ratcheting up to the moon. That is a sign that the world is no longer just kind of curious about worrying about the U.S. Treasury or worrying about the U.S. debt levels or worried about Uncle Sam's IOUs. No, they're generally, absolutely, openly, and obviously worried now. Again, that's what we're seeing. And that's the real truth. Trust in the dollar, trust in the 10-year, trust in the U.S. Sobriety, mental health, physical monetary health is now clearly at its all-time lowest in years. And that's why we're seeing this move. It's absolutely tied to the debt, to the treasury market, to the currency market, to the precious metals market, to our monetary policy. It's all tied together. And the COMEX is just the latest symptom. When you combine the COMEX outflows and inflows with the treasury auctions that since 2022 or 2000, really since 2014 have been net buyers of gold and net sellers of treasury, that's a symptom that they don't trust the dollar and the treasury. And if you look at since we weaponized the U.S. Treasury under the Putin sanctions, whether you like them or not, whether you agree with them or not, the annual central bank purchase of physical gold has doubled since 2022. These are all connected. The distrust of the U.S. IOU, the preference for a tier one asset in physical analog pet rock gold form is higher than that paper IOU from Uncle Sam. It's really that simple. It's dramatic. It's not the end of the world, but it's like I said in my most recent article, what COMEX is saying is the case for gold is now almost too obvious for anyone who takes a half an hour to understand what the COMEX really does and what these flows really mean. And again, Sheckman, Alistair, McLeod, all of us, anyone who's been tracking the COMEX and understands what goes on there sees this very clearly. And I'm sure most of your viewers and audience does too. It's really quite sad and quite expected and quite predictable. And now it's no longer projecting or saying there's a problem. It's happening in real time right now. It's happening in real time.
London has long been the epicenter of the global gold trade, home to the infamous London Bullion Market Association, LBMA, shadowy network of banks, traders, and institutions that oversee billions of dollars in gold transactions every single day. For decades, it has functioned as the world's gold liquidity hub, where central banks, hedge funds, and billionaires go to buy and sell massive quantities of the metal. But now something unprecedented is happening. The gold is running out. Just recently, one of the world's largest refineries sounded the alarm. London's gold vaults were nearly empty and the market had dried of liquidity. Then, the Bank of England quietly admitted that deliveries of allocated gold, metal that investors had already paid for, would now take 4 to 8 weeks instead of the usual 14 days. In the world of gold trading, this is a default in everything but name. When a market that claims to have near unlimited gold can no longer make deliveries on time, it means only one thing: there isn't enough physical supply to meet demand. This raises a crucial question. If the London gold market is running out of gold, how much of the reported supply is even real? Much like COMEX, the LBMA operates largely on a paper gold system. The vast majority of trades in London don't involve the transfer of actual gold bars. They're settled in unallocated accounts, essentially IOUs for gold that may or may not exist. But here's the issue. Investors and institutions are waking up. Instead of rolling over contracts, they're demanding physical delivery. And this is where the real crisis begins. If even a small percentage of investors demand their gold at the same time, the entire system collapses. The LBMA doesn't have enough metal to cover all its obligations. And when the truth comes out, gold's price suppression will shatter, leading to an explosion in price. To make matters worse, the Bank of England has reportedly asked other central banks to lend it gold that should already be sitting in its vaults. This is a sign of desperation. When a system built on trust starts scrambling to borrow gold to cover its obligations, it tells us one thing: that trust is gone. And this isn't just a gold crisis, it's a fiat confidence crisis. The moment the market realizes the gold simply isn't there, the domino effect will spread far beyond London. Because gold isn't just an asset, it's the foundation of the entire global monetary system. And when gold disappears, fiat currencies begin to crumble. And that brings us to the next phase of this unfolding catastrophe, the death spiral of the US dollar.
Sheckman and many of us have been talking about for years, this game can only go on as long as the COMEX has the physical gold. But the reason they don't have the physical gold, for all the reasons the BRICS are de-dollarizing, and from the reasons Charles de Gaulle came in New York Harbor in 1971 and the Germans in 2016 and India and China since, why everyone's repatriating their physical gold. They want their physical gold because they think of it as a better tier one strategic reserve asset than a U.S. Treasury or an IOU from Uncle Sam, who has a weaponized and over-indebted dollar and untrusted IOU or U.S. Treasury. It's that simple. And so countries, counterparties, trading desks, you name it, want actual physical gold, which is completely new to the churn and burn, keep it spinning and rolled over COMEX market of old. And so what we're seeing here is a fascinating symptom of what is not being discussed openly. This is not tariffs. This is not price arbitrage between New York and London. This is a world turning away from the U.S. Treasury as a tier one asset, turning away from the U.S. dollar as a safe asset, and preferring that boring analog pet rock physical gold as a strategic asset, as the BIS has warned, as the BRICS have shown, as frankly even the Trump administration and Scott Bessent recognize. Scott Bessent's a very big gold investor. But you can't say the quiet part out loud. You can't have the New York Times, the Wall Street Journal. I'm not a conspiracy quack, but you can't say the world wants its gold. COMEX is being drained because no one trusts Uncle Sam's IOU. Physical delivery is going out the door for a reason. You can't say that because what that means is the gold price is rising, as we're seeing, all-time highs in all currencies at the same time this is going on. This is not a coincidence. If the gold price rises, this is a thing that terrified Kissinger and Nixon and Volcker years ago. If the gold price rises out of control of the COMEX and the permanent boot to the neck under the futures market, that means the US dollar, the mighty dollar, and the US 10-year treasury, the IOU, simply isn't what it used to be. Doesn't mean the end of the dollar, doesn't mean the end of the world reserve currency, doesn't mean the end of the 10-year IOU. It just means that we're no longer talking about when things are breaking down. They are breaking down. And so what we're seeing in the COMEX market is absolutely fascinating. It's record levels of physical delivery coming in and physical delivery going out. In terms of the gold price, there are two ways to look at this. You could say, well, okay, I hear you, Matt, but they needed physical gold to continue this post-Basel III short. They needed more physical gold to play this paper contract game. Now they've got it. Can't they now continue to exercise the ratio of 4% gold, 96% paper, and keep shorting gold or silver? What I'm saying is that depends on if the gold that's coming in, the 400 metric tons and counting, either stays put or is a revolving door to keep going out so that the COMEX can meet its delivery demands. The question will be, is the gold stockpile on the COMEX warehouses a movable feast, revolving door going right back out, or is it being restockpiled to continue the short? And that's
The US dollar is in free fall and the signs are everywhere. Decades of reckless money printing, trillion-dollar deficits, and unpayable debt have set the stage for a crisis that can no longer be ignored. Inflation has gutted the purchasing power of everyday Americans, and foreign nations, the ones who have propped up the dollar for years, are dumping US debt at an alarming rate. For decades, the dollar's dominance was built on one key pillar: trust. The world believed in the US financial system, in the Federal Reserve, and in the idea that the dollar was the safest currency on the planet. But that trust is crumbling. Central banks across the world are racing to get rid of their dollar reserves and replace them with gold. A move that signals one thing loud and clear: they no longer believe in the dollar. China, Russia, and even longtime US allies like Saudi Arabia are reducing their reliance on the dollar, moving toward trade agreements that bypass the once dominant petrodollar system. And here's why this is a ticking time bomb. For over 50 years, the global economy has been structured around the petrodollar agreement, where oil exporting nations agreed to sell oil exclusively in US dollars in exchange for military protection. This system forced every major economy to stockpile dollars, artificially inflating its demand and allowing the US to print money without consequences. But now, that agreement is falling apart. Saudi Arabia has publicly stated it is open to accepting other currencies for oil, and China has been aggressively pushing its gold-backed yuan oil trade system. If the petrodollar collapses, demand for US dollars vanishes overnight, triggering a sell-off that could crash its value and send inflation into hyperdrive. And this isn't just speculation. The Federal Reserve itself is panicking. With debt levels spiraling out of control, the Fed faces an impossible choice: raise interest rates and risk a catastrophic market crash, or keep printing money and watch inflation destroy what's left of the economy. No matter what they choose, the dollar is in trouble. The endgame? Gold. Throughout history, every fiat currency eventually collapses, and when that happens, people turn to hard assets. That's why central banks are hoarding gold at record levels. It's why institutions and billionaires are quietly accumulating physical metal while telling the public that gold is obsolete. And it's why the coming gold revaluation will be the biggest financial event of our time. But the dollar's collapse isn't just a financial crisis, it's a global power shift. And at the center of this shift is one country that has been playing the long game, stacking gold and preparing to rewrite the rules of the financial system: China.
Look, it's not their fault, and it's totally understandable. I've said this many times. It's not a conspiracy theory. Again, there's a deliberate process in my education in the U.S., from kindergarten to grad school, in our media, in our banks, in our registered investment advisory offices, and our prop desks at Goldman Sachs, to the PW, private wealth management at Morgan Stanley or Barclays, to Wharton, Harvard Business School, etc. No one is taught about sound money or gold. No one is. We're talking about optimizing. We're talking about rate of return. We're talking about volatility in the precious metal space. and focus on risk assets, annualized return, fight inflation through diversification in stocks, et cetera. In other words, there's a deliberate misunderstanding of physical gold because physical gold is about sound money, and the entire raison d'etre to the American system post-1971 is unsound money. So it's not discussed. There is no Austrian school from Wharton to Darden to Harvard to Yale School of Management. Whereas if you come to Europe or you come to the East, these conversations are daily had. And it has, as someone who works out of Zurich with clients in Singapore and Istanbul and all over the world in 90 countries, including many from America who get this is not unusual for the East. It is extremely hard for the Americans, not because they're stupid. It's because they've never been taught this deliberately. They're meant to misunderstand this. The government, the central banks, and the education system, knowing their unknowingly, doesn't teach it. Because it's really the biggest fear, a system that's debt-based like America has post-71, the biggest fear that system has is a full understanding of physical gold as a wealth preservation asset against dying fiat money. So it isn't even a conspiracy theory. It's a natural survival instinct. So a lot of retail investors, they're told gold is too volatile. It's outperformed the S&P this entire century. Of course, not in a straight line, but of course it's not too volatile. And the direction is not about gold as a volatile precious metal. It's about an alternative money source, sounder money, not just a hard asset. It's not understood in the West. Retail investors, they're being taught by their advisors and their DNA and our culture. Look, is opportunity cost in gold? Yeah, it's up 25, 27%. But you know what?
For years, China has been quietly executing one of the greatest financial power plays in modern history, a calculated, methodical accumulation of gold that could soon reshape the global monetary system. While the West has been drowning in debt and propping up fiat currencies with endless money printing, China has been doing the exact opposite, stacking gold, reducing its reliance on the US dollar, and positioning itself as the new financial superpower. Here's what most people don't realize. China isn't just buying gold. It's actively working to undermine the dollar's dominance. Over the past decade, China has imported thousands of tons of gold, dramatically increasing its central bank reserves while downplaying the true size of its holdings. Officially, China claims to have around 2,000 tons of gold, but independent analysts suggest that the real number is likely over 20,000 tons, making it the largest gold holder in the world. And they're not just hoarding gold, they're changing the rules of the game. In 2016, China launched the Shanghai Gold Exchange, SGE, a direct challenge to the COMEX and London Bullion market. Unlike Western markets, which rely on paper gold contracts, the SGE requires physical delivery of gold. This means that when you buy gold in China, you get real metal, not a paper promise. This alone is a massive disruption to the rigged Western system that has suppressed gold's price for decades. But here's the real bombshell. China is moving toward a gold-backed yuan. China has already begun pricing oil in yuan, an unprecedented move that threatens the petrodollar. But more importantly, it's offering something no Western country can: a gold convertible currency. By backing its oil trade with gold, China is creating a system that allows nations to bypass the US dollar entirely. And countries are taking the offer. Saudi Arabia, Russia, and even BRICS nations like Brazil and India are now exploring trade deals that settle in gold-backed yuan instead of dollars. This is the beginning of the end for fiat dominance. When confidence in paper currencies collapses, nations will demand settlement in real assets. And guess what? China is ready. The US and Europe, on the other hand, have spent years manipulating gold's price instead of accumulating it, a decision that will come back to haunt them when gold's true value is finally unleashed. And make no mistake, gold's revaluation is coming. When the world realizes that the COMEX and LBMA don't have enough physical gold to cover their obligations, when the last bit of trust in fiat evaporates, and when China and other nations demand a financial reset, gold won't just rise. It will be forced to find its true price. The question is, how high will gold go when the manipulation breaks? Some analysts say $3,000, others say $10,000. But the real numbers, the ones based on actual money supply, suggest that gold could reach levels never seen before in history. The great gold revaluation is coming, and when it happens, those who saw it coming will be the ones who benefit the most.
because we have a money printer. We can add a zero at any central bank and solve the default problem. We can try to produce our way out of this debt crisis through GDP, but as von Mises or David Hume or Ernest Hemingway or any good professor in any business school will tell you, when your debt to GDP crosses 100% and gets into the 125%, mathematically your growth stalls by 1/3. So we can't grow our way out. So the only other option, the third option, is to inflate our way out. We're debasing the currency. As we debase the currency, gold goes up. As gold goes up, nations and counterparties on the COMEX want their gold out of the warehouses, and nations around the world want to buy twice as much gold as they did pre-2022. They're buying twice as much now because they trust gold more. It's that simple. Does that mean that gold will only go in a straight line? No, because if we do eventually see mean reversion in the market, I'll say this, if the markets go down 50, 60, 70%, as they should at some point, unless we nationalize them, literally, we could do that. But in a moment of mean reversion or even a recession, anything that's not nailed down is going to be necessary to cover margins. And so gold could retrace. We can't be certain of that, but even as a gold executive, I can't just say gold only goes up and to the right. So of course, but the trajectory, secular, 3,000, 3,500, 4,000 is just the beginning. And that shouldn't be to get your juices flowing for speculation. You should buy gold for 20, 30 years out for the long term, because there's no miracle for paper money anymore. We're seeing extreme examples of that right now at the treasury auctions, at the COMEX, among the BRICS nations, all of which have their own problems, by the way. It's not as if the BRICS are totally healthy and America's the only one ill. It's not as if the things that Trump is trying to do to cut spending are totally naive. What I'm saying is it's far too little, far too late. And so to your question, yes, gold will continue to go higher, not in a straight line. Of course, if we have a real crisis in the markets and the markets are got plenty of needles pointed at their red balloon, you could see a small retracement in gold and then really raking high to all-time highs. If you're a speculator in gold and you're waiting for that price pullback, fine. If you're an owner and you're looking 30 years out, whether you buy tomorrow or wait for a pullback is irrelevant. And that's why it's a good question. But my simple answer is I just never look at the price because I just know it's going to get significantly higher by the time my grandkids and kids and I need it 20, 30 years out. That's my horizon. It's always been that way.
Gold's true value has been buried under decades of manipulation. But when this artificial suppression breaks, the revaluation won't just be a slow climb. It will be a violent explosion. The forces that have held gold down for so long are now losing control. And the coming price surge could make today's predictions look laughably conservative. For years, gold has been artificially suppressed through unbacked paper contracts, market manipulation, and central bank interventions. But as we've already seen, that system is unraveling. The question now isn't if gold will be revalued, it's how high it will go when the real price discovery begins. Let's break it down. Historically, every time a major fiat currency has collapsed, gold has been revalued upwards to reflect the true amount of money in circulation. In 1930, during the Great Depression, the U.S. government revalued gold from $20 to $35 an ounce, a 70% overnight jump. In 1971, when Nixon ended the gold standard, the price quickly soared from $35 to over $800 in just a few years. And today, we're looking at a situation that dwarfs those past crises. If gold were to be revalued based on global money supply, the numbers become staggering. Right now, the total M2 money supply in the U.S. alone is over $20 trillion. If gold were to fully back that supply like it did under the classical gold standard, the price per ounce would need to be at least $15,000. And that's just for the U.S. When you account for global fiat money, the number could easily exceed $50,000 per ounce. Sound extreme? Remember, gold has been suppressed for decades. Its real price has been held down through derivatives, fake supply, and central bank manipulation. When that breaks, gold won't just rise, it will snap back to its natural valuation in one of the largest wealth transfers in history. But here's the critical part. This won't be a gradual shift. Gold moves violently when fiat collapses. We saw it in 1980, when gold soared nearly 800% in under 3 years. We saw it in 2011 when gold jumped from $700 to nearly $2,000 in 2 years. And this time, the setup is even bigger. Central banks are already preparing. Nations are hoarding gold, cutting dollar exposure, and positioning themselves for a post-fiat world. The markets may not have realized it yet, but the biggest players already know what's coming. And the biggest question is, What happens after gold breaks free? If fiat is collapsing, what comes next? Because once the dollar's purchasing power is obliterated and gold has revalued to levels no one thought possible, the world will be forced into a new financial system, one that could change everything we know about money.
I know it's like I was listening to Alistair McLeod talking to Dunnigan the other day, and we were talking about this notion of can kicking, us gold buns, because we talk about how the debt's been kicking the can. As Alistair rightly said, we're not even talking about the can kicking anymore. The can has been kicked. Now we're hitting that point where the debt really is now mattering. So the gold price direction is now going to accelerate. Even von Mises warned about this, but that was in the 1950s. We're 2024, 2025 now. Now the debt problem is no longer academic, even though I never thought it was. This was just a matter of time and how long we could go. What we're seeing is it's no longer debatable. Now we've hit that wall. That does not mean that gold only goes in a straight line. But what we are seeing now, undeniably, in the last couple of years and really gaining momentum in the last year and a half and certainly the last few weeks, is that, again, the gold market is going to go into a secular bull market, not because gold's properties have changed or gold has gotten shinier or more interesting or more aware. And frankly, the West still doesn't understand gold. The gold market is rising because the fiat money world, the US credit system, the global credit system, which is money to them, which is just credit, is in a clear bear market. And the most simple way to say that and show that is you have to remember, it's a fiat bear market. A 400 ounce bar of gold, when we had 1971, before we went up the gold standard, I think it was 17,000. A 400 ounce bar of gold today is 1.14 million. Again, gold has not gotten stronger since 1971. The US dollar has gotten weaker. That's why the gold price is rising. The dollar is getting weaker because it's been monetized to an extreme and criminal degree to cover US debt levels, which are beyond the pale of rational, the highest debt levels in the history of the world, and certainly in the history of America. If debt destroys currencies and debt destroys empires, we are at that turning point. Again, not the end of the world, but a very different world. Not the end of the world reserve currency, but a very different currency, respect-wise, use-wise, tier-wise, strategically reserved-wise. The de-dollarization of the BRICS is not a joke. The de-dollarization of the COMEX is not a joke. The move towards gold is not a gold bug argument. It's history in motion. And the price of a gold bar, a 400 ounce bar from 17,000 to over $1 million is not a gold bug argument. It is a symptom of fiat money in general and the US dollar particularly dying. So people need to get past people talking their book or gold guys talking up gold. But of course, gold is going to go higher because there is no way out of this debt crisis. There are three options, Elijah. There are three options with gold. Or the U.S. debt crisis. We can default, which I don't think is a real option.
The collapse of fiat money isn't just about gold skyrocketing, it's about what comes next. When paper currencies fail, the financial system doesn't just pause and reboot. It fundamentally changes. And right now, the world's elites are already preparing for that shift. The global economy is built on a foundation of debt and trust, two things that are now crumbling at an accelerating pace. Once fiat collapses under its own weight, governments and central banks will have no choice but to introduce a new monetary system. The real question is, what will that system look like? There are only a few possible outcomes. A gold-backed reset. Historically, when fiat fails, gold steps in. Nations may be forced to reintroduce gold backing to restore confidence. China, Russia, and BRICS nations are already positioning for this, accumulating record amounts of gold while moving away from the US dollar. If the world moves to a gold-backed system, it would mean a massive revaluation of gold, possibly exceeding $50,000 per ounce. Central bank digital currencies, CBDCs. The financial elites don't want a gold-backed system. They want control. That's why central banks worldwide are pushing for CBDCs, programmable digital currencies that allow governments to track, tax, and even control how money is spent. This is the most dystopian outcome, as it could lead to total financial surveillance, where governments can impose negative interest rates, limit transactions, or freeze accounts at will. A multi-asset reserve system? Some experts believe we're moving toward a hybrid system, where gold, commodities, and digital assets, like Bitcoin, play a role in backing currencies. This would be a radical departure from the current system, but it would still result in a dramatic repricing of real assets like gold and silver. Whichever path the world takes, one thing is certain: fiat currencies are dying, and gold will be at the center of whatever comes next. The transition won't be smooth. There will be panic, volatility, and chaos as the financial order resets. But those who saw it coming, those who understood the warning signs, will be the ones who come out ahead. And that brings us to the final, most crucial step: what you need to do to prepare. Because this isn't just another market cycle. It's the most significant financial event of our lifetime.
Nvidia can go up higher. A good tech stock can go up. Bitcoin, you can't beat its annualized return, etc. There's always something shinier, better. There's always an opportunity cost. There's always something to optimize. The Western American mindset, I come from it. I was a speculator. I certainly respect it. I understand it. It is not thinking wealth preservation. It's thinking, how do I get more? How do I optimize? How do I get a better return? Even though the returns on gold are fantastic. The idea that the great American dollar, like the flag on Iwo Jima, could ever come down is unthinkable. It's not taught, it's not discussed, it's deliberately misunderstood. Whereas in the East, it's very well understood. So there's no coincidence that Eastern central banks are stacking physical gold. The World Gold Council has no clue how much gold is being stacked in China and Russia and the East. But we do know that England, I mean, housewives in India have more gold in the entire country of the UK. They have nothing, because Gordon Brown got rid of it when they thought that the British pound sterling was good enough. So you're seeing a seismic shift in a West versus East understanding, in a retail versus sophisticated understanding. There are plenty of young or not necessarily highly affluent retail investors in America, though, who fully understand gold and silver. And they do, but they're a minority, and they've been deliberately kind of sidelined. But again, we have clients from 90 countries. We have many clients from America. I cannot divulge, but they put in tens and tens of millions of dollars in physical gold. They're not quacks. They're not conspiracy theorists. They're not kooks. They're fairly sophisticated people. Many of them are bankers who understand sound money. That's it. Unfortunately, our culture, my country, the US I come from, this was not taught. It just was not spoken about. It wasn't even encouraged at the banks I worked with or the prop desks I traded from. It wasn't encouraged. And again, it's not a conspiracy, but there was a deliberate decision to just go around that particular issue. Whereas in the East, countries who've been through war, who've been through inflation, who've been through regime change, who've seen things go from the sublime to ridiculous, gold is very carefully understood. It's certainly in Switzerland, it's very carefully understood. These aren't quacks. They just understand sound money and history and inflation and currency debasement and how it's all linked together.
The financial system as we know it is coming to an end. The cracks in COMEX, the collapse of the London gold market, the death spiral of the US dollar, these aren't isolated events. They're all part of the same inevitable reality. The fiat money experiment is failing, and gold is about to reclaim its place as the foundation of global wealth. For decades, governments and banks have manipulated markets, printed trillions out of thin air, and convinced the world that pieces of paper backed by nothing could function as real money. But history tells us the truth. Every fiat currency eventually collapses, and when it does, gold is always the final safe haven. Now, we're watching that moment unfold in real time. Central banks are hoarding gold. Major institutions are demanding physical metal instead of paper contracts, and nations are openly moving toward a post-dollar world. When the COMEX finally snaps, when the last ounce of physical gold is drained from the system, the price suppression will shatter and gold's real value will be unleashed. The question isn't if gold will skyrocket, it's how high and how fast. Some analysts believe $5,000 gold is conservative. Others see $10,000, $20,000, or even $50,000 per ounce as the only logical outcome when gold is finally revalued to reflect decades of suppressed demand and worthless paper money. And when that happens, those who prepared early will be the ones who come out ahead. This isn't just about profit, it's about survival. It's about protecting your wealth, your future, and your ability to navigate the greatest financial shift of our generation. The time to act is now. The system is unraveling, and the window to position yourself before the breakout is closing fast. If you see what's coming, don't wait for the headlines. By then, it will be too late. Make sure to stay informed, subscribe for more updates, and most importantly, always do your own research and consult with a financial professional before making any investment decisions.